Ever stare at your bank account, wishing your money would just do more? You're not alone. Many of us feel like we're constantly running on a financial treadmill. Meanwhile, you hear whispers about the market and investing, but it sounds like a secret club with its own language, right? It feels overwhelming, confusing, and maybe even a little risky. But what if I told you that building an investment portfolio isn't just for Wall Street gurus? It's a powerful tool anyone can use to grow their wealth confidently. Today, we're demystifying it. So, why invest at all? Because simply saving money isn't enough to beat inflation and reach your long-term goals. Your cash loses buying power over time. Investing is about putting your money to work for you so it can grow and compound over time. Think of it as planting seeds today to harvest a forest later. The real magic happens with compound interest. It's when your earnings start earning their own returns, creating a snowball effect, making your money grow exponentially. Imagine a small snowball. As it rolls, it collects more snow, growing bigger and bigger. Your investments do the same, especially over many years, accelerating your wealth. This is why starting early, even with small amounts, gives compound interest more time to work its wonders. Time is your biggest ally in investing, not market timing. Now, let's talk about your investment portfolio. Don't let the fancy word intimidate you. It's simply a collection of all your investments working together. Think of your portfolio like a garden. You wouldn't plant only one type of crop, right? If that crop fails due to bad weather, your whole harvest is gone. Instead, you plant a variety: vegetables, fruits, flowers. This way, if one struggles, others can still thrive, ensuring a healthy overall harvest. This is diversification. In investing, diversification means spreading your money across different types of assets, companies, and industries. It helps reduce risk by not putting all your eggs in one basket. Let's look at some common investment types. First, stocks. When you buy a stock, you're buying a tiny piece of ownership in a company, like Apple or Google. If the company does well, your piece of it can increase in value, making you money. Stocks offer high growth potential, but also come with higher risk. Next, bonds. Think of bonds as loaning money to a government or a company. They pay you back with interest over a set period, like a loan. Bonds are generally considered less risky than stocks and provide more stability, though their growth potential is typically lower. They're a good counterbalance in your portfolio. For beginners, a great way to diversify easily is through funds, like exchange-traded funds, ETFs, or mutual funds. These are like instant portfolios bundling many investments. When you buy a share of an ETF or mutual fund, you're buying a tiny piece of hundreds or even thousands of different underlying investments all at once. This gives you broad diversification without having to pick individual stocks or bonds yourself. It's often the simplest and most effective starting point for new investors. So how do you actually start? First, decide how much you can comfortably invest regularly, even if it's a small amount like $50 or $100 a month. Consistency is key. Next, open a brokerage account. These are accounts specifically designed for investing, and many reputable online brokers make this process straightforward and user-friendly. Once your account is set up, choose low-cost, broadly diversified ETFs or mutual funds. Look for ones that track major market indexes, like the S&P 500. For simplicity, the best strategy for most beginners is to automate your contributions. Set up an automatic transfer from your bank account to your brokerage account each payday, effortlessly. This removes emotion from the equation and ensures you're consistently investing, regardless of what the market is doing. It's a powerful habit that builds wealth automatically. Remember, the market will go up and down. That's normal. Don't panic during downturns. These can actually be opportunities to buy more at a lower price for more future growth. Investing is a long-term game, not a sprint. Focus on your goals years or even decades away, not daily headlines, and ignore the noise. Patience truly is a virtue here. Building your first investment portfolio might seem like a huge leap, but it's just a series of small, consistent steps. You have the power to start building real wealth right now. Don't let fear or complexity hold you back any longer. Take that first step today, even if it feels small, because every journey begins somewhere. Your future self will thank you. You don't need a finance degree to invest wisely. You just need to understand the fundamentals and commit to the long haul. Empower yourself to take control of your financial future. If this video helped demystify investing for you, hit that like button. And subscribe to Wealth Lever for more practical, no-nonsense financial advice to help you build your future.